All right, let's get to another top story, and that is the housing market. Some say it's got a split personality. No sooner did we get good news last week that the month of July had the highest monthly increase in sales in a decade, did word come that residential mortgages and foreclosures with at least one payment past due hit 13 basically percent in the second quarter. That is the highest percentage ever recorded by the Mortgage Bankers Association. To help make sense of housing's dueling data, I'm joined by Kendra Todd, host of the HGTV's My House is Worth What, and head of the real estate firm, the Kendra Todd Group, and Fox Business senior economist Mark Lieberman. Good morning, guys.
Good morning.
All right, Kendra, let's start with you. What is it that we're seeing, these signals, and why specifically was that data in July so strong?
Well, the reason why we had a 7.2% monthly gain, which has been the highest monthly gain in 20 years, is really because of a few factors. One, increased affordability, the $8,000 tax credit, which is going to expire in November, and some very aggressive government-backed lending programs, not to mention favorable media reports. But, you know, we're not at the bottom yet. We're going towards what I like to call a temporary peak as part of a W-shaped recovery. So I think we're going to see some more favorable numbers as far as home sales for a few more months, but come November, it's going to drop again until we hit our final bottom.
Very interesting, Kendra, because you mentioned November, and Mark, a lot of eyes are focused on that because that first home buyer tax credit expires at the end of November. There's a big push by the real estate CEOs to get that postponed to a later date, or extended, I should say, and to not just have it be a first home buyer tax credit, but to allow anybody to participate in it so they can get the trade up market moving. What does that mean?
Well, that would obviously mean that if you have a 7-room house and you want to buy a 9-room house, you have the ability to do it. But as in most things, there are the unintended consequences of this and many economic factors. In this case, the first-time homebuyer tax credit could be used for a down payment in some instances, in a lot of instances, in fact. And the aggressive government lending programs that Kendra spoke of, too, have a downside to it. Because one of the things you like to see as a lender when people are buying a house is they have their own money in it, their own stake in it. They're less likely to default in that. And we've seen a couple of things that pose some warning signs for the housing market. It's a little followed indicator that the MBA also puts out. Adjustable rate mortgage demand is up to the highest level it's been in almost a year. 6.5% of all mortgage applications in the last weekly report were for adjustable rate loans. And as I said, that's the highest it's been in a year. When you match that up against the MBA delinquency statistics, you find, not surprisingly, that adjustable rate loans have a higher delinquency rate, one payment or more past due, than fixed rate loans. So these are some dangers, especially at a time when mortgage rates have been dropping.
So Kendra, the mortgage delinquency story, 13% highest recorded data. What do we do about that? How problematic is that for housing?
The reason why I think it's so problematic is the fact that those numbers are being driven primarily by borrowers with traditional fixed-rate mortgages. So as unemployment rises and we start to see more corporate layoffs, we're going to continue to see these delinquencies and foreclosure rates higher. And the problem with that is that it's flooding the market with excess inventory, most of which are distressed sales. I mean, it's a startling number that only about 10% of all home sales right now are actually conventionally purchased. So until that starts to level off and until people start getting equity back in their properties, we really are playing with a bad hand.
And I would presume too, Mark, that it's not just about subprime delinquencies. What they're concerned about now is prime delinquencies.
Absolutely. And what we saw was that the increase in the percentage of delinquency, and the delinquency rate percentage for prime mortgages was just a hair less than the month-to-month, the quarter-to-quarter rather, increase in the delinquencies for subprime loans. And I might add another thing that contributed to the strong home sales that we saw, and indeed will contribute to improvement or a less bad number in tomorrow's Case-Shiller Index, is the time of the year we're talking about. Home sales usually peak in the June-July period as people with families try to buy a house house, get into the house before school begins, and that's the season we're in. Home sales will likely, if they don't drop off, will certainly increase a lot less dramatically as we get later in the year, almost a perfect storm. We're going to see rates starting to rise a little bit. We're going to see the expiration of those tax credits of which we spoke, and we're going to be outside of the seasonality for home sales.
Okay, don't make me nervous.
I'm sorry.
You know, gosh, we all own a home and a mortgage. Oh my goodness gracious.
Yeah, but you're still working.
Yeah, all right. Mark and Kendra, thank you guys very much. I appreciate it.